Hello, good day, people. How are you? Okay, so finally, here's our lecture on technical analysis. I do hope most of us have already started with the Forex Trading Bible, and we probably have an understanding of some of the concepts that are described in that book, especially the concept on price action. Remember, we said we are going to be using mostly price action in our trade execution and in our strategy. So it is very, very much important that almost all of us understand what price action is. And that is the reason why we had to send the Candlestick Trading Bible, because for you to understand price action, you need to understand the behavior of candlesticks. You need to understand what candlesticks are and what data they represent. So basically, technical analysis is the study of the past price movements in order to predict the future price movements. So it is more of using the concept of probabilities, the same way that price has moved in the past can also influence how price is going to move in the future. So you find maybe I'm going to give an illustration now. Um, of course, our very example where we were using the Zim dollar versus the Nigerian naira. Okay, so remember, people, this is our time and this is our price or rate. Okay, so we are saying that okay, so we are going to be studying what has happened in the past. All right, what has happened in the past, and then that is going to be our basis on which we're going to predict what is going to come up in the future. All right, so if price has moved in a certain way in the past, if the same setup is going to come and present itself in the present, then price should move the same way in the future. Okay, so basically technical analysis is us studying what has happened before, and we use that to estimate or to predict what is going to happen next. All right. Even though we're going to focus mostly on price action, it is also imperative that we understand market structure. Okay, so market structure is us studying the basic ways in which the market moves, or the market is going to set itself. Okay, so there are certain moves that you can just tell at the back of your head. When you look at the market, you must be able to tell what kind of market structure the market is presenting to you. Remember, when we say the market, we are basically looking at what the graph is saying. What the graph is giving you is basically a part of the rate. So we're saying whatever part of the rate represents a certain market structure. All right. So we should be able to interpret what market structure is currently in the market. Okay. So I'm just going to list a number of different market structure patterns that we look at, and the ones that are important for us to understand. Okay, so number one, we have what is called the ranging market. So whenever you hear the word ranging, just by a mere understanding, you can tell that price is moving between two specific levels. Okay, and then it is constrained to that specific channel that is being offered by the two different levels. So you have a level that is on top, which would like to call the supply zone, and then the level which is below, which is basically termed the demand zone. Okay, so we're saying a ranging market is usually going to be constrained within this range. Okay, it is going to be moving in a sideways manner. The price is not moving in a specific direction. You cannot tell whether it's going up or down. It is basically ranging, or it is oscillating within two different levels. The one on top is called the supply zone, and the one below is called the demand zone. So the next type of market structure that we're going to talk about is of trending markets. All right. So from the word trending itself, you can tell that the market is sort of trending in a certain direction, or everyone who's jumping into the market is also jumping into the trend hence making the market move in a certain direction. So for example, when you see the market moving in a certain way, in this case the market would be in what is called an uptrend. Why? Because the market is mostly constrained to be moving upwards. Okay, so we're saying whenever you hear the word trend, you should be coming in and looking at a certain direction that the market is moving. It's either the market is in an uptrend, or the market can be in a downtrend. Okay, remember we only have two directions that we mainly focus on as forex traders. It's either the market is going up or is going down. All right, so in the case of an uptrend, that means the market is going to be trending upwards. And then in the case of a downtrend, okay, so this one is termed the downtrend. So in the case of a downtrend, the market is going to be moving downwards. Okay, so what really are the components of an uptrend? Of course, the components of an uptrend is higher highs and higher lows. Okay, so we're going to be getting higher highs and higher lows, higher highs and higher lows. So every time you see the market giving you higher highs and higher lows, that means that market is in an uptrend. Okay, but remember, people, even though the market might be moving in an uptrend, it doesn't mean that you're not going to see slight movements in the opposite directions, which are called retracements. Okay, so you're going to be getting retracements. There is no market that is going to move straight up without any retracement. Okay, the market is going to move in a certain direction, but there might be retracements. So even though you would have seen that the market is in an uptrend or is in a downtrend, you need to be very careful, because you might enter at the high top there of a market. Maybe you want to enter a buy in an uptrend, and then you enter when the market is actually at its highest peak. That means you're going to have to carry the loss of the retracement before the market can come back up. So the best positions for us to be entering the market, for example, in an uptrend, would be when it is at its lowest level, at its higher low. Okay, so that you can be able to ride the whole swing. All right, let me just give an illustration. What we are saying is that let's give an example of an uptrend. We're saying the market is trending upwards. Okay, so of course you're going to be having your higher highs and your higher lows. Okay, you're going to be having higher highs and higher lows. So we would want to make sure that the position that we are entering the market is the one at the lowest, when the market is just finishing the retracement, so that we can be able to ride the swings. Ladies and gentlemen, this means that every time you see an uptrend, you're going to have to wait for the retracement to happen before you can enter the market. Okay, we're going to look at the different types of market entries that we use. We just don't enter the market. That is when price action is going to come into place, whereby we'll be using the engulfing candlestick pattern, or the three marching soldiers, or three black crows marching, the three black crows pattern. Okay, so we should be able to understand these concepts. What is an uptrend and what is a downtrend? Okay, so let me just to cement this understanding, let me give an illustration of a downtrend. Okay, downtrend. So we're saying the downtrend, the market is going to be moving downwards. Okay, it's going to be trending down. So what comprises of a downtrend? Of course, we're going to have a lower low, lower highs and lower lows. Okay, lower high and lower low, lower high and a lower low. So this is going to tell you that this market is actually a downtrend, because we have lower highs and lower lows every time the market is breaking structure and going downwards. Okay, so remember we said these moves are called swings. Okay, the main moves in the direction that we want, the main moves in the direction of the trend are called the swings, and the temporary movements in the opposite direction of the trend are called retracements. Okay, they're called retracements. This is a retracement. Okay, so there are going to be temporary movements of price in the opposite direction of the trend. Those are termed retracements. So we don't want to be entering the market when it is retracing. We want to be entering the market when it is actually in the swing. Okay. So this is the concept of trends in terms of market structure. So there are different strategies that are centered around trending markets. It's either you can be trading using the concept of trends, or you can be trading using the concept of the ranges that we've talked about, the supply and demand zones. Okay, so in this course, we are going to talk about the two different methods: the trending markets and the ranging markets. So now that we understand a bit on market structure, um, it is time we understand how different statistical data of how buyers and sellers are acting is represented in the market. Okay, so to represent this statistical data of the behavior of buyers and sellers, people in the market, buyers and sellers, it's always a battle between the buyers and sellers. Now you find when you're in the market, the buyers are called the bulls and the sellers are called the bears. So that is the reason why you find someone might tell you that it is a game of bulls versus bears. So whenever you hear the word bullish, it means it is referring to the buyers. Okay, the bulls will cause a market to move upwards in a bullish manner. Okay, so this is always a fight between the buyers and the sellers, or a fight between the bulls and bears. Okay, so buyers are the bulls and the sellers are the bears. All right, so this is when the concept of candlesticks comes into place. What candlesticks are? They are basically bars that represent the behavior of buyers and sellers within a specific range of time. Okay, so we're saying whenever you see a candlestick, it is going to be representing a set of information. This information is going to tell you whether in a certain time interval the market is being controlled by buyers or sellers. The market, if the market is being controlled by the bulls or by the bears, whether the market is bullish or bearish. Okay, I've just said the same thing here. We said the buyers are the bulls and the sellers are the bears. So whenever the market is being controlled by the bulls, the market is bullish, and whenever the market is controlled by the bears, the market is bearish. All right, so that is the concept that we are going to use to describe the anatomy of a candlestick. Okay, since we now have an understanding of what bears and bulls are, what a bearish market or what a bullish market is, maybe it's time that we get to look at the anatomy of a candlestick. Okay, so remember we said that every time you come into the market, it is always a war, or it is always a battle between buyers and sellers. So what the buyers are trying to do, they are trying to push the market up, and the sellers are trying to push the market down. So we said a candlestick is going to be a representation of who is winning between the buyers and the sellers. Okay, so let's take an example of a tug of war. We are saying we have a starting position, and let's say this side we have the buyers, and then this side we have the sellers. Okay, so it's a tug of war. The buyers are going to be trying to push the price up. Okay, and the bears are going to be trying to push the price down. Okay, so every time you see a candlestick, it is representing who has won between the buyers and the sellers in a certain time interval. Okay, so I'm just going to give an illustration and on the anatomy of a candlestick. So now, to give an illustration on how candlesticks operate, we're going to use the concept of, I know most of us know what a tug of war is. It is that game in which people try to pull each other on different sides, and of course there's a line in the middle. The ones that are pushed to the other side are the ones that actually lose. So that is what we are saying. It's more of sort of like a tug of war between buyers and sellers. Okay, so we're saying the buyers are on top here, are on this side, and the sellers are down here. Okay, so what the buyers are trying to do, they're trying to push the rate upwards, and then the sellers are trying to push the rate downwards. So a candlestick is going to measure in a certain time interval which ones between the buyers and sellers have managed to push price to their own side, and by how much, okay, and by what margin if they pushed price to their certain direction. So for example, if we say it is the buyers that have managed to push price in their own direction, remember people will say this is the opening price. So it is always fair in the beginning of any time interval, where the market starts is the opening price, and then after a certain time interval we're going to be measuring which one between the buyers and sellers have managed to push price in their own direction and by what margin. Okay, so let's say in this market the buyers have managed to push price in their own direction, but before they did that, remember we're saying we're measuring in a certain time interval. Let's take for example we are measuring in a 4-hour interval. Okay, so in the first hour the sellers are actually the ones that have managed to push price in their own direction from the opening price. Okay, but after an hour the buyers started getting much more strength and then reversed price and moved it in their own direction. Okay, and then the buyers actually got more strength, and then the time interval, the 4 hours, actually ended when the buyers were in control. So whenever the price closes, whenever the time interval that we have given is finished, that one is called the closing price. Okay, so we are saying the opening price and the closing price would determine whether the market has been controlled by the buyers or the sellers within that specific time interval. So in the 4 hours, the market ended up being controlled by the buyers, and then the market actually got to close off that interval, that specific interval that we were measuring in the buyer side. So this will be termed a bullish candle. Remember the concept of bears and bulls. When we say it's a bullish candle, we are saying that this market is being controlled by the buyers. Why? Because in this tug of war, in this war that was happening, even though the sellers managed to push price in their own direction in the first hour, on the last 3 hours of the 4-hour interval, the buyers started gaining strength and reversed price from whatever position the sellers had taken it up to their own side. And the size of this bar is going to determine the margin by which the buyers have actually managed to push price in their own direction. Okay, so even though the market had been controlled by sellers in the first hour, the good thing about candlestick is that they're going to show you that the market actually went on to a certain level. So this is going to be called the lowest price. All right, so this being called the lowest price, it is going to be represented by a wick, and this one is a body. Okay, so we're saying the wick is going to show us where price was or where price got, but later on got reversed from. Okay, so even though when you come in the market, maybe you were not there in the first hour, you just got there when the 4-hour interval was finishing off, and then when you come in and you look in the market, you see that the buyers are winning. That wick there is going to show you that at a certain time the sellers were actually winning, and the sellers actually managed to move price up to the lowest level. The lowest level or the lowest price is going to be where the wick has ended. Okay, so that little line there is the wick, and that is called, the one on top there, the margin by which the buyers have managed to move price in their own direction, is termed the body. So the size of the body is going to determine whether by how much margin the buyers have managed to move price in their own direction. Okay, so just to cement this anatomy of a candlestick principle, let us look at a bearish market. Okay, we're going to look at a bearish market. I hope by now we all understand what a bearish market is. We're going to look at how a candlestick of a bearish candle is going to look like. Okay, so remember we said it's sort of like a tug of war. So of course we're going to have an opening price or an opening rate. Okay, and then in this scenario, the buyers tried to move price in their own direction. Okay, let's say we're measuring on the 4-hour interval. So this happened in the first hour, and then later on price was reversed and the sellers gained control and actually managed to move price in their own direction. Okay, they even went on to move it further down, but as time moved, the buyers ended up gaining much more strength, but they were still not able to go beyond the opening price. Hence, as a reason, the sellers won the market. Okay, so this one will be termed a bearish candle. Okay, why is it a bearish candle? It is because the closing price, this closing price here, is lower than the opening price. We are saying the opening price, from the opening price, the sellers actually managed to push the price down, hence giving a bearish candle. Even though in some hours of that interval, the buyers had strength and actually moved price in their own direction, but it was later on reversed. And as we can see by the week, it is telling us that price has been reversed from a certain level that it had been taken by the buyers. Okay, and even though the sellers won this market, they could have won by a higher margin, but the buyers got much more strength to reduce the size by which the sellers had actually won the market. Okay, so that is also going to be shown by a wick. So every time you see a wick, it is basically showing you that price has reached a certain level. So this will be your lowest price, and then this will be your highest price. Okay, so this is a bearish candle. Why is it a bearish candle? It is because the sellers or the bears have managed to move price in their own direction from the opening price. It is always a fair game. The market starts at the same opening price, but what will determine whether it's the buyers or it's the sellers that have won the market is the closing price. If the closing price is going to be higher than the opening price, then it means that the buyers have won and it's a bullish candle. And if the closing price is lower than the opening price, then it means the sellers have won the market and it is a bearish candle. The size of the body, remember people, this is the body. The size of the body is going to determine the magnitude in which the sellers have won or the buyers have won. It is going to determine the magnitude of the bearish candle or of the bullish candle. So now we're going to understand the concept of price action. Now that you know how candlesticks behave, it is time that we look on into price action. Remember people, price action is basically us looking at the behavior of candlesticks. Why are we looking at the behavior of candlesticks? It is because candlesticks are the one that carry the statistical data of the market. The candlesticks are the one that are showing us whether the market is bullish or the market is bearish. Remember, from the candlesticks, whenever we have the market coming in, let's say we have an opening price and the closing price is above there, and then of course this would be the highest level, and then this one will be the lowest level, and then of course this is going to be the body, and then these are wicks. Okay, so what we are saying is that if the closing price is higher than the opening price, then this one is going to be a bullish candle. Why are we saying it is a bullish candle? It's because from the opening price the market was actually pushed higher, and the closing price ended up being higher than the opening price. Hence, this market is being controlled by buyers, or is being controlled by the bulls. Hence, this is a bullish candle. Okay, So us having this understanding, we can then be able to interpret the market to say, this candlestick has been measured. Let's say, for example, it was being measured in a 4-hour interval. So if we are coming into the market and we're saying in the last 4 hours, it is the buyers or it is the bulls that have actually managed to push the market in their own direction. Therefore, this market seems to be controlled by the buyers, and you'd want to be on the side of the buyers so that you can take advantage of the direction of the market. Okay. So now, with the nature of candlesticks, it is not a good thing, or it is not a good practice for us to just make decisions based on just one candlestick. What we are going to be looking at are candlestick price formations or candlestick chart patterns. Okay, we're going to be looking at the patterns that are going to be formed by these candlesticks. Okay, so let's take for example that we are going to most of the times I was just drawing the market like this, but you find when you look on your MT5, the market is actually represented by various number of candlesticks and lots of candlesticks. So these candlesticks are going to form what are called patterns. The different patterns that these candlesticks are going to form are going to be the ones that tell us or give us an interpretation of the market, and these are the ones that are going to be using as our entry triggers. Okay, whenever we see a certain price action pattern, whenever we see a certain candlestick formation, we are going to be using that to interpret the market based on the significant levels that we have talked about. Whenever you see a price action formation, or when you see a price action pattern at a certain level, maybe at a retracement level, then that should be a trigger, or it should be a communication of the market to you on whether you should be getting in a buy or getting in a sell. Remember, if you are getting in a buy, you anticipate that the market is going to go up. If you're getting in a sell, you anticipate that the market is going to go down. So if you are a buyer, you are a bull, and then if you're a seller, you are a bear. The good thing about the market is that there is no restriction whether for one to be only a buyer or only a seller. You can be a buyer and a seller at any specific market at any specific time based on what you are seeing in the market. That is the reason why you have the buy and the sell button, to mean that you can enter in a buy whenever you feel that the market is going to be moving in an upward direction, or you can enter a sell as well whenever you feel that the market is going to be moving in a downward trend. Okay, so I know most of us have been reading the Candlestick Trading Bible. There are lots of price action patterns that are in the forex trading Candlestick Trading Bible, but for us in our strategy, we mainly employ 3 price action patterns which we are going to talk about. Okay, the most important price action patterns that we are going to follow. Okay, so number 1 is called the engulfing candlestick formation. Okay, number 2 that we're going to be focusing on is the morning star or the evening star candlestick formation. And then lastly, we're going to be focusing on the 3 marching soldiers or the 3 black crows. Okay, so these are the 3 main patterns that we are going to be focused on: the engulfing candlestick formation, the morning star or the evening star candlestick formation, and of course the 3 marching soldiers or the 3 black crows candlestick formation. Okay, so for now let's look at the engulfing formation. Okay, the engulfing formation. So for this one, of course, remember we said the market has 2 main directions. It's either it is bullish or it is bearish. So that means for each of the price action patterns that we are going to be following, we're going to be looking for the bullish scenario and the bearish scenario. Okay, so to start off, let us look at the bullish engulfing Okay, so this one, you can tell from the word bullish engulfing, it is going to be a price action pattern for the buyers. It is a price action pattern that is going to be utilized by buyers. Okay, so let's take an illustration here. For example, the market is moving downwards. There is a series of bearish candlesticks. Okay, a series of bearish candlesticks. Then from Norway, we are going to get a large bodied candlestick in the opposite direction that is going to engulf the previous candlestick. Okay, so this pattern here, it is this pattern here that we are going to term the bullish engulfing. Okay, why are we saying it is the bullish engulfing? Is because there is a very big bullish candle that is just arisen from Norway, and it has engulfed the previous bearish candlestick. So here is the bullish engulfing pattern. I just had to redraw it so that I can illustrate properly. Okay, so what we are saying is that the previous bearish candle has been engulfed by a large bodied bullish candle. Okay, so what this is saying is that there is a huge chunk of buyers that is emerged in the market. We are saying even though the market was being controlled by the sellers, in the different time intervals that were being given, most of the candlesticks were bearish, which means the sellers were winning. But now all of a sudden, there is a very large body. Remember, we said the size of the body of that candlestick is going to determine the margin by which the buyers or the sellers have won. In this case, the buyers have won by a very large margin. We can see that by the size of the body. So the size of the body of that candlestick has actually gone on and engulfed the size of the previous candle. That is the reason why this is a bullish candle. So we're going to anticipate that the market is going to move upwards. Why? Because there is a huge amount of buyers that have emerged in the market. And then, of course, for the bearish engulfing, what we are saying is that the bulls have been winning in the market. Okay, so the market is being controlled by the bulls, and then all of a sudden we are going to have a very large bodied bearish candlestick. This is meaning that a large chunk of sellers have entered the market. All right, so we're going to anticipate that the market is going to move down. Why? Because this chunk of sellers has emerged in the market to mean that the sellers must be gaining control of the market. So this is going to be termed the bearish engulfing. We are going to be using it as a trigger to enter into the market. So whenever you see the bullish engulfing or the bearish engulfing, it is going to determine whether you're going to enter the market in an upward direction or in a downward direction. So if you are going to see the bullish engulfing, that means you're going to be pressing the buy button. And if you're going to be seeing the bearish engulfing, then that means you're going to be clicking on the sell button because you anticipate that the market is going to go down. Okay, so this is the engulfing pattern, and I'm sure most of us now understand what bears and bulls are. Okay, so now we're going to move on to the second price action pattern formation that we use in the market. So let's start off with talking about the morning star. Okay, the morning star. So for example, let's say that the market is actually moving downwards. All right, there is a series of bearish candlesticks. Okay, a series of bearish candlesticks, and then we're going to get a doji candle. People, whenever you see a candlestick like this one, it is called a doji. What this doji represents, it is saying that in the given time interval, there is no body on this candlestick. When there is no body, it means that it's more of a draw. The buyers and the sellers could not decide the direction of the market. There was no winner, even though there are weeks. Even though there are weeks there, the market was not able, in the given time interval, there was no winner between the buyer and the seller. So there was indecision in the market. this candle represents indecision. Okay, it's called the doji. Maybe you can also look at it. I'm sure it is there in the Candlestick Trading Bible. Okay, so whenever you see a doji, it means that there is indecision in the market. After the indecision, then comes a bullish candle. Okay, so what this is going to represent, it is going to represent that even though there was indecision in the last session, the next session then proved who the winners are. Because even though there was a draw last time, in the next session, the buyers actually emerged and won this market. So this means that this market must be going up. Why? Because the buyers have came in the market. We have seen that with the bullish candle that is represented itself. So the pattern that we are going to be looking at and terming the morning star, the pattern that we're going to be looking at and terming the morning star is this pattern right here. Okay, is this pattern right here. When you see a bearish candle, all right, followed by indecision and a bullish candle, all right, so this pattern is going to be named the morning star. It is representing the buyers gaining control. Why? Because there was indecision in the last session, and then in the next session we got strength from the buyers. That means this market must be going up, so you'd be looking to buy this market. And then of course we're going to look at the evening star. The evening star now we are saying is the opposite, or is the reverse of the above scenario. We are saying the buyers are actually in control of this market. Okay, and then we're going to see an indecision or a doji candle. After the doji candle, we are going to see a large bearish candle. Okay, so this is going to represent that a large chunk of sellers has entered into the market, and they should be looking to gain control of the market. So whenever you see this pattern here, let me just change my pen type. Okay, so whenever you see this formation here, this is what we call the evening star. We are saying there is a smaller bullish candle and then an indecision candle. People, this is indecision. There is no winner between the buyers and the sellers. And then of course in the next session we then see the sellers gaining control. So we should look on to sell this market. Why? Because we have seen that a large chunk of sellers has entered into this market. Okay, and then lastly we look at the third major price action pattern formation that we look at, okay, which is called the three marching soldiers or the three black crows. Okay, so now we're going to start off with the three marching soldiers or the three white soldiers. Okay, so what you're going to see is that the market might have been moving downwards. Okay, the market might have been moving downwards, of course, getting different types of candlesticks, sometimes almost getting candlesticks, pin bars and everything. And then all of a sudden you're going to see the market coming in. Of course, it's going to give you three candlesticks with similar body type, similar wicks, showing you that the buyers are now gaining control of this market. They are gradually gaining control of the market. Okay, so whenever you see similar bodied candlesticks of the same type, so you have seen the first candlestick has a certain type of body and certain types of wicks, and it is a bullish candle. The second candle is just similar to the previous one, and the third candle is just similar to the previous two. So these ones are what we're going to be calling, these ones here are the ones that we are going to be calling the three marching soldiers. Okay, what this represents is that the buyers are gradually gaining control of this market, so we should look on to buy this market. Why? Because there is a gradual control of the market from the buyers. Okay, and then of course people, we are going to look at the three black crows, which is the reverse of the above. What we are saying is that the market was moving upwards, given different types of candlesticks, but the general direction of the market was upward. And then all of a sudden, you're going to see three similar sized body type candlesticks of the different in the different direction. Of course, these ones are bearish candles that have emerged with the same body type, same types of wicks. So these ones are going to be termed the three black crows. Okay, so these ones are actually the three black crows. What they are representing is that the market, the sellers are gaining control of this market, and we should anticipate that the market is going to continue going down. Okay, so as you can see, we have looked at the three major price action patterns. Of course, on each major pattern there are two scenarios, or the buy and the sell scenario. Okay, so it is very much important that we cement our understanding on these three major price action patterns. Why? Because these are the ones that we are going to be using in our price action. These are the ones that we are going to be using in the strategy. Okay, so I think for today we have really exhausted price action and market structure. Okay, so I think we give it a breather for now so that we can grasp this concept that we have given, and then we should continue in the next lesson, whereby we'll be actually going on MetaTrader 5 and looking for these specific price action patterns and seeing how they actually played out. Okay, so I hope we are reading the Candlestick Trading Bible, and we are having an understanding of how the markets work. Hello, good day, people. How are you? Okay, so finally, here's our lecture on technical analysis. I do hope most of us have already started with the Forex Trading Bible, and we probably have an understanding of some of the concepts that are described in that book, especially the concept on price action. Remember, we said we are going to be using mostly price action in our trade execution and in our strategy. So it is very much important that almost all of us understand what price action is. And that is the reason why we had to send the Candlestick Trading Bible, because for you to understand price action, you need to understand the behavior of candlesticks. You need to understand what candlesticks are and what data they represent.